Here's how my health insurance strategy would change if I were self-employed and made $75,000, $150,000, and $300,000 a year. Choosing the wrong plan doesn't just mean higher premiums. At $75K, it can cost you thousands in lost tax credits, while at $300K, it could mean missing out on a powerful tax advantage savings tool. Assuming you're healthy and buying your own coverage, the best plan for you looks very different depending on your tax bracket. Today, we're breaking down the specific strategies for each income level so you can build a health plan that actually aligns with your income and protects your bottom line. If you're a freelancer making $75,000 a year, you're earning more than the national average, but as an entrepreneur, you know that money doesn't always go as far as you'd like. Most people at this level are still in growth mode. Every dollar spent on an insurance premium is a dollar that isn't being reinvested into your business. At this income level, your biggest fear isn't a $50 copay. It's a large, unexpected medical expense that wipes out your business runway. Your risk tolerance is naturally lower because you need cash on hand to keep the lights on. The strategy here is to prioritize predictable monthly costs. Instead of trying to win by getting the lowest possible out-of-pocket costs with a high premium plan, I would prioritize a plan where the monthly premium is affordable and consistent so that my insurance bill isn't competing with my business investments. The good news is that at $75K, you may qualify for significant help through the ACA marketplace depending on your household size. For example, if you're the sole breadwinner in a family of 4 making $75,000 a year, you're sitting right between 225% and 250% of the federal poverty level. This is a sweet spot because you could qualify for 2 types of assistance: premium tax credits, which lower your monthly bill, and cost-sharing reductions, which actually lower your deductibles, copays, co-insurance, and out-of-pocket maximums. Now, I can't recommend a specific plan for your situation, and this is just an example, but in this scenario, a silver plan is something I'd strongly consider because they're the only ones where cost-sharing reductions apply, potentially making the total cost of your healthcare cheaper than it would be had you bought a lower premium bronze plan instead. But be sure to compare plans across all tiers and speak to a qualified professional about your specific circumstances to choose the best plan for you. And here's a checklist I'd keep at this income level. Make sure you have enough savings to cover your deductible at a minimum and ideally your out-of-pocket maximum. To keep that monthly cost down, stay in network. Before you sign up, verify your doctors are covered or be comfortable switching to providers who are in network. Confirm your regular prescriptions are in a lower tier like generic or preferred drug to keep pharmacy bills manageable. At $75K, we aren't trying to optimize every single penny. We're trying to make sure that one bad health year doesn't turn into a total financial disaster for your business. Once you're making $150,000 a year, the game changes. At this level, you've likely phased out of most marketplace subsidies. You're paying full price for your coverage, which means your main challenge is balancing those high premiums against your actual out-of-pocket costs. At this income level, your biggest fear is probably overpaying for protection you won't actually use. You have more financial flexibility than the $75K earner, but you still want a plan that's forgiving if your healthcare needs change mid-year. The strategy here is to run the total cost math. Instead of just looking at the monthly premium, I recommend calculating your total annual cost. This means looking at what you'll pay in a healthy year versus a catastrophic year. To do this, I suggest using a tool like healthplancompare.com. You can plug in your specific plan terms like your premium, deductible, copay, and out-of-pocket maximums, and it will generate a graph to show exactly how much you'll spend as your healthcare needs increase. This takes the guesswork out of the decision and shows you where one plan starts to become more expensive than the other. If I were running plans to compare at this income level and I were healthy, I'd strongly consider adding a high deductible health plan or HDHP to my comparison. That's because you can pair these with an HSA, allowing your health insurance to double as a tax shield, helping you save money on healthcare when you're no longer eligible for subsidies. An HSA is a triple tax advantage account. Your contributions are tax deductible, the growth is tax-free, and the withdrawals for medical expenses are also tax-free. At $150K, lowering your taxable income is one of the smartest ways you can give yourself a raise. Another reason I'd consider an HDHP and HSA combo here is the flexibility. If you have a low-use healthcare year, that money stays in your HSA and grows into the future, plus you benefit from the savings of lower monthly premiums that these plans have. But if you have an unexpected medical event, you can also use those pre-tax dollars to pay the bill, which is usually higher in high-deductible health plans compared to higher premium plans. It's a strategy that's forgiving because part of the money you have in your HSA is money you would have otherwise lost to taxes. The checklist for this income level becomes: compare the total annual cost, which is the premium plus the deductible plus copays and coinsurance. You want to compare those of a high premium, low deductible plan versus a high deductible health plan, keeping in mind that high premium plans are typically not HSA eligible. Contribute as much to your HSA as possible if you go with a high deductible health plan to help provide cushion for unexpected medical events. Also, since you have more flexibility, you might be less willing to switch doctors. I'd prioritize a plan with a broad network, like a PPO, if seeing certain specialists were important to me, even if the premium was slightly higher. At $150,000 a year, we're moving away from just avoiding a disaster and moving towards getting the most value from every dollar. You want a plan that protects your health without leaking cash that could be better used elsewhere. Once you hit $3,000 a year in self-employed income, your mindset around health insurance needs to shift. At this level, your most valuable asset isn't just your business, it's your time. You have the financial flexibility to choose almost any plan, so your main challenge isn't the cost of the premium, it's ensuring that your insurance never becomes a hurdle that slows you down. So your main strategy here is to buy back your time with network freedom. At this income level, I would prioritize a PPO plan. You cannot afford to spend your workday waiting on an HMO gatekeeper or chasing down referrals. But more importantly, a PPO plan typically offers the nationwide coverage you need if you're traveling frequently for business or speaking engagement. You need your coverage to be as mobile as you are. Another strategy here to take is the health IRA play. Even though I'm prioritizing the network, I'm still looking at a high deductible health plan. Now, usually people choose high deductible health plans because they want the lowest possible premium, but at $300K, we aren't choosing it to save on the monthly bill, we're choosing it for the tax advantage. If you're healthy and don't visit the doctor often, an HDHP allows you to open an HSA, which I like to think of as a health IRA. Use it today for tax-free medical expenses, but it has a powerful hidden feature. After age 65, you can use that money for non-medical expenses. At that point, it functions like a traditional IRA. You'll pay your income tax on the distributions, but the 20% penalty for non-medical use that existed for withdrawals before 65 disappears. Finally, at this income level, you should consider a concierge medical plan to complement your health insurance. Traditional medical practices are often volume-based, which limits the time a doctor can spend with you. Concierge doctors flip that model. They offer 24/7 direct access, same-day visits, and even home visits. This is highly personalized care where the doctor has more time to focus on you. And here's how it pairs with your insurance. It's important to remember that concierge medicine is a supplement to your coverage, not a replacement. In most cases, you still need health insurance to cover hospital stays, specialists, and emergency care. Because of this, many people at this level pair their concierge membership with the high deductible health plan we discussed earlier. This way, you still have personal access that you want while still having coverage for larger medical expenses. Now, the way that these doctors interact with insurance varies. Some do not accept insurance, while others may still bill your insurance for specific services. It's essential to clarify how your specific plan will work with their model before you sign up. From a financial standpoint, there is a key distinction to keep in mind. You can often use your HSA to pay for eligible medical services provided by a concierge doctor, such as office visits or lab work, but you cannot use it to pay the monthly or annual membership fee itself. The checklist at this income level is administrative simplicity because you want a plan that provides strong customer support and a dedicated advocate to help you find doctors and navigate claims. You also want wellness and lifestyle benefits, which include conveniences like nutritional counseling and health coaching to help you keep performing at your peak. Also, you're looking at cross-functional wealth building. Maximize that HSA as a secondary retirement bucket. This way, you aren't just buying insurance, you're building a tax-advantaged asset for the future. At $300K, your health insurance isn't just a bill, it's the support system that helps keep you in the game. As your business grows, your health insurance shouldn't just be an item on your to-do list, it should be a strategic asset that scales with you. If you found this breakdown helpful, hit that like button. It really helps this channel reach more self-employed people like you. Let me know down in the comments below which strategy you're leaning towards this year. Thank you for watching, and I'll see you in the next one.